Okay, perfect. So we will get started now. So we have got 29 participants, including us. And again, the objective, as I said, is we are educating you on how to build a sustainable and sizable property portfolio. So when we refer to sizable, we are referring to the number of properties or the worth of the properties that we are accumulating. And sustainable basically refers to the sustainability aspect of the portfolio, that while you're holding them, it's not financially painful to you. So we'll get started. We'll start with our introduction first, and then we'll get to the topic. So we both are the presenters, myself and Deepak. So I'll be covering majority of the section. Deepak will be jumping in to help out to cover some of the sections here. So a bit about myself here. So I basically moved to Australia in July 2017. So after completing my 10 years of IT in India, so I came on a permanent residency visa to seek a better lifestyle. So while I was staying in, while after joining in Australia, I stayed in IT for almost 5.5 years. And an incident in 2022, which was a car accident, actually turned everything for me. So it pushed me to do something meaningful. So the job in IT was a mid-management role. I was working as a data engineering manager in Combank as well in the last role, and it was just not fulfilling. So I founded InvestorAid, which is a buyer's agency focused on helping people build wealth through real estate investing. So we are basically only working with investors, and our focus is only to be buying good cash flow properties in the growth markets. So I bought my first investment property, which was my principal place of residence in mid 2019, and the latest acquisition was in December 2024. So my portfolio now holds 11 properties worth over $10.7 million now. So, and 8 of these purchases were done while I was working in my 9 to 5 in the initial 3 years between mid 2019 to mid 2022. And after that, I had to pause because I had to start my business. And then, as many of us might know, that once you get into the business and the business is not old enough, like it is very difficult for you to get lending. So I almost exhausted all my lending with my PYG income at the time. Yeah. So yeah, these are some of the portals that you might have seen myself. So yeah, I was featured in news.com.au back in April 2023 when I was just in the very beginning phase of my buyer's agency career, and at that time I was at the verge of leaving my job. So this was the exact same month when I left my job, exactly on my birthday. And then there was a recent article published on realestate.com.au, which was, I think, last week. And then I have been into a few podcasts. So you can go to Geared for Growth podcast for hearing the complete story. And then I have touched upon this particular concept of building a scalable and sizable portfolio with Vanessa Dallas in her podcast at the Intrepid Investor. Yeah. So over to you, Deepak, to introduce you.
Thanks, Rohit. A little bit about myself, guys. I moved in Australia in 2016, and I was a telecom engineer back in India for 10 years. And initially, when I moved over here, I took some IT-related job, but after a few years, I realized I was satisfied with the work I was doing. So I joined InvestorAid 2.5 years ago, and since then, I've been assisting a lot of clients like yourself to secure properties to start their journey. And I assisted like more than 40 to 50 clients in past 2.5 years, and that's it for me, Rohit.
Okay, perfect. Thanks, Deepak, for introducing yourself. Yeah. So
Okay. Before we move further, guys, I would like to read a quick disclaimer. You can read the full disclaimer on the screen, but I would just highlight the few points over here. The information provided in this webinar is for general informational purposes only and does not constitute financial, legal, tax, accounting, or property advice. It has not taken into account your individual objectives or personal circumstances. Before acting on any of the content, we strongly recommend seek advice from a qualified and independent professional relevant to your situation. Thank you. I think, Rohit, we can get started. Over to you.
okay, perfect. Thank you. So I'll get started now. Okay, perfect. Okay, so now getting to the topic, right? Why does everyone keep talking about these days building a property portfolio instead of buying a single property, right? So we keep hearing that a lot. And what benefits do we get by building a portfolio, right? So before we get further, I would be asking a few questions just to understand my audience a bit better. so that I can tweak my learning accordingly. The first question I want to ask is, how many investment properties do you own? Like, and we have put a poll on the screen. If you can just respond to that, so we would have a good understanding of the audience. Oh, this is interesting. Okay, perfect. So 69% of the people have participated, which is great. 23 people have answered, out of which 9 doesn't own any investment property. 5 has got 1, 2 have got 2, 2 have got 3, and 5 people have got more than 4, which is amazing. Fantastic. So good to know. So I'll ask another question now. So what is the most common issue you face when building or scaling a property portfolio? So the common issue that you face when building or scaling a portfolio. Okay, so again, 23 people have answered. 8 of them have said money or lending. 1 is time poor. 8 are lacking the education around the space. And 3 are not able to act. And 3 are lacking confidence, which is fine. And just a last poll here. Again, where do you want to see yourself in the next 10 years in terms of your portfolio, excluding the principal place of residence? Okay, great. This is great that majority of you, 25 out of 30 responses, are wanting to get past 4 properties, which is amazing. Perfect. So we'll probably discuss the ideas and the key topics here on how you can actually scale faster, scale better, in a sustainable way. Perfect. So we will first start with the definition, what property portfolio is, right? So what is a property portfolio and why do people need it, right? The first, so property portfolio is nothing but a collection of properties, especially investment properties we are talking here. So more than one property can be classified as a property portfolio. Right. So again, the scale will depend on individuals, what their aspirations are, where they want to take themselves. And the reason why people talk about building property portfolio is because purchasing a single property will not likely help you achieve your financial goals. Like it could be early retirement, it could be passive income or significant generational wealth, right? The other benefit is that multiple properties let you diversify across multiple locations, which basically spreads your risk. And then also you gain benefits of different market cycle timings, because all different markets are operating at different times. So if you are ready with different purchases at different times, you can keep tapping into the right markets at that point in time and just have maximum upside potential for capital growth. And then it also creates multiple streams of income from different properties, so that you are not dependent on any individual tenant. And so say, for example, if you've got 5 properties, one tenant vacates, you are not just left out of pocket, and you have got other tenants to be paying the rental. Yeah, we'll move on. Okay, so now we know why people need to build a property portfolio to grow their wealth, right? Let's understand how to build it in a sustainable and sizable manner. Right, so we'll take an example of 3 couples here in a very similar situation. We will just focus on how they have done things differently and how it has transformed into very different outcomes. Right, so both partners for all these couples are working in IT with a combined household income of 250K, and 1 year is their investment journey. Right, so now we will have some assumptions here for the ease of understanding and for ease of calculations. So the first thing that we are assuming here is an annualized growth rate of 6% for a 10-year period, right? And we are pretty much close to CoreLogic's last 30-year average for regional and capital combined, which is sitting at 5.4. So no holding cost, as the property is neutrally geared on interest-only loan for 10 years. And then we are excluding the purchase and selling cost here, again, for ease of calculations and understanding. And all of these are investment properties. We are not talking about principal place of residence here. So let's go and see how it looks like, right? For couple 1, they basically end up buying 1 property. Couple 2 ends up buying 3 properties, and couple 3 ends up buying 5 properties. And because they were on similar incomes and had similar lifestyles, they had got similar borrowing capacity. They would have done exactly the same way, like couple 1 and couple 2 would have bought exactly the way the couple 3 has bought 5 properties, but it was just because they were either lacking confidence or they were just wanting to take it too slow, right? So the couple 1 ended up buying 1 property for $400,000. Couple 2 ended up buying this per single purchase price was $400,000. but the total investment with 3 properties became $1.2 million. And couple three basically ended up buying 5 properties of 400,000 each, and the total investment became $2 million. So the total value after 10 years for couple one was $716,000. And for couple two, it was 2.15, close to 2.15 mil. And for couple three, it was 3.58 mil, right? So the gains, the capital gains, again, excluding the purchase cost here, the capital gains for couple one is sitting at $316,000. For couple two, it is sitting at 940, almost 950K. And for couple three, it's sitting around $1.58 million, right? So similar family circumstances, but they have taken different actions and very different results, right? So here we can clearly see that the gains are higher with higher investment, right? But now the key question we have got is, can we achieve similar capital gains if couple three would have just bought a single asset with a similar investment of $2 million, including mortgage? And I would like people to respond in the chat what they think. Yes, no, whatever you think is, or possibly yes, like if you're not sure. We'll just wait for 5-10 minutes. Sorry, 10-15 seconds, and we'll. Okay, no. Okay, that's great. No. Yep. Less likely. Okay. Possibly. Yep. Possibly yes. Perhaps no. Okay. We'll just wait for another 10 seconds to see if we have got more answers coming in. Oh. Okay. So the short answer is possibly yes, right? Because if you were able to buy, based on your borrowing capacity, you were able to buy 5 properties, you can possibly buy again, depending upon the cash flow and how much buffer you have left to play with in your borrowing capacity, you possibly can even buy a single property, right, worth $2 million. So another question that I've got is, why bother with multiple properties when one property can yield similar capital growth long term, if bought right? Right? Less hassle to maintain, isn't it? Right? So for many of us who are Sydney based, a $2 million is a standard typical home, 40-50 kilometers from the city. And it's very easy because it is in our backyard. We can easily go over the weekends and buy it ourselves. We don't need any help there. Right? But the real problem here is that there is a concept called yield compression. So once the rental yield typically for a standard residential home reduces with increases in prices because of affordability reasons, right? So the tenant are not able to the rentals don't rise as much as the prices do, right? So with increasing prices, you see the rental yields dropping, right? So let's map these to real locations and numbers to understand to have a better understanding. So I'll start adding this. Sorry, I'll start mapping this to the location. So we are taking an example of a $2 million home, a typical $2 million home in northwest of Sydney. Northwest of Sydney, and this suburb is called Bockham Hills. So a typical standard residential home of $2 million looks like this, right? So the potential return in terms of rental is around $1,000 per week. So we are assuming here that the owner has paid 20% of the purchase cost from his pocket, 20% of the deposit as well as the purchase cost from his pocket. And he has taken a loan of 80%, which is $1.6 million, right? And assuming the interest rate was at 6%, so the total interest cost came out to be $96,000 for the year. And the gross income from the property at $1,000 per week comes to $52,000 per year. And the gross cash flow, again, we are excluding other expenses like property management and insurances and other property maintenance cost. So the gross cash flow for each year comes to be minus 44 grand. So if you start adding other costs, the net cash flow will be even more negative than this. But for ease of calculation, we are just considering the gross cash flow for each year. So the gross cash flow comes as 44,000 negative. So two questions: does it look painful? Possibly yes, to many of us, especially for the people who are at 250K combined family income, right? Now, another question I've got is, can you afford to buy another property like this? If your intention is to be able to build a portfolio, then would you be able to buy more than this? Okay, so assuming you have made good capital gains as shown in the previous slide, assume you would have made 1.56 or whatever that number was in terms of the overall capital gains for couple three, you would have made similar gains. The biggest problem with this strategy is that if you have bought a single asset, the only exit strategy you have got is to sell and stop cash flow completely and also the possible future capital gains, which is a very big problem. So it is a binary equation. You either get to zero investment property or one investment property. You don't have much options there. So let's see if we have got better alternatives which solves this problem. Same investment, but a very different way of operating, right? So now we are taking a practical example. This is a real property that we bought for our client on 31st of December at 4:15 p.m. We have signed the contract on this. So we bought this property, which was a 4-bed, 2-bath, 2-car park modern home, around 10 years old home. And this property was bought at $400,000. So this property is 1 kilometer from the beach. The land size was 670 meters. So it's a standard 4-to-2 configuration home. It's not an inferior asset by any means. So we bought it in a market where there were growth fundamentals. There were the supply and the demand metrics were very favorable, and based on that, we bought this property for our client. The potential rent on this, so the rental appraisal on this at the time when we bought it 2.5 years ago, it was $500 per week. I think this time it might be over 600. And the owner again paid 20% deposit from his pocket and the purchase cost. And then the loan amount on this property was $320,000. So the interest cost again at 6% came out to be around $19,200. And the gross income from the property comes to 26,000 for the whole year at $500 per week. So the gross cash flow for each year becomes 6,800 positive here. Again, we have ignored the other cost. It would be slightly less than this, but it might still be positive. So this is just one example of the property, right? So I've got a few questions here, right? You have seen both the scenarios, what these three couples have bought as an individual purchases and what you have got an alternative option of investing $2 million in a single purchase in Sydney, right? So a few questions. Can you buy 5 of these properties? I'm talking about this now. So can you buy 5 of these? And of course, yes, if you can afford to buy the one in Bochum Hills based on your borrowing capacity, you certainly can buy 5 of these. And the reason is because with these properties, your rentals are going to be higher. So it will be expanding your borrowing capacity further. So speak to a mortgage broker. They are much better than myself on this. And can you buy more than 5? Possibly yes, because as I said earlier, a higher cash flow would stretch your borrowing capacity. And it might, because if you look at these examples, $2 million investment with these kind of purchases would be looking at a rental potential of around 2.5 grand per week in as opposed to $1,000 per week from the other property. $1,500 extra rent per week translates to how much? $78,000 for the year, for the whole year. Okay, so and does the cash flow position in this look painful? Definitely not, right? Because it is positive. By any means, if you can buy 10, 20, 50 of these assets, as long as you have got the deposit and the borrowing capacity sorted, these are not costing you anything to hold. Perfect. So now in this recent example that I've shown at $400,000, do we have options in exit strategy? And we have got multiple options here, right? One of the option could be that you accumulate 5 assets like couple 3. One of the exit strategies, you sell 2 or 3 assets. So let's assume you have sold 3 assets when the portfolio doubles. Say, for example, in 10 years, usually that has been the time frame in Australia on an average. So in 10 years, your portfolio doubles. Out of 5, you sell 3. Let's assume the capital gains of 1 goes into the capital gains of the overall 3 properties. The remaining 2, the proceeds from the remaining 2 properties can then pay off the debt on the previous ones. So as we have taken an assumption that they were on interest only loan, let's assume they have not even reduced uh, their initial principal payments. So initial principal amount, right? So these 2 assets can pay off the debt on the other 2. One goes to the ATO. So then you have got 2 debt-free assets, which can then give you a passive income. So usually when you talk about people, like I keep talking to so many people, and most of them have got a goal of achieving a passive income. The only way for you to be achieving passive income goal fast is to be building a portfolio and then liquidate some assets and pay the other. Otherwise, the usual strategy on P&I would be holding the assets for 30 years, which is probably the slowest way to do that. And then you can, as I said, like without that, you can then hold the remaining assets. So the key message here is that in order to make significant gains in real estate, you are required to be building a bigger portfolio, right? And in terms of dollar value, right? Because say, for example, if you are considering an average return of 5.4% as per core logic, and you have just made an average purchase, you have not done your, let's assume that you have just gone out, bought a property and held it for next 20, 30 years, and it just performed at core logic's average, it is basically increasing still by 5.4%, which means for on a portfolio value of $1 million, you are getting richer by $54,000 each year. But if you are able to expand that portfolio to $10 million, again, definitely through borrowing, you could be looking at an average, at the nominal average growth of 5.4, you are looking at $540,000 growth on, and I'm talking about compounded annual growth rate, CAGR. I'm not talking about each year you will be getting richer by $500,000, but on long-term average, your compounded annual growth rate would be closer to $500,000, right? So, and in order to build a bigger portfolio, you're required to focus on both capital growth and cash flow, because you really cannot hold multiple assets with a negative cash flow situation. Like when I say negative, like I'm referring to heavy negative, like definitely in some cases, once you are making a purchase, just to be realistic, you have to buy sometimes assets which are slightly negative. But anything which is heavy negatively geared will be hampering your borrowing capacity and will limit your ability to grow your portfolio faster. Okay, so just checking with everyone, are you guys following it? Do you want me to go a bit slow, or you're getting it, what I'm saying? You can type in the chat or unmute yourself and say.
Yeah, a little bit slow will be better, Rohit.
Ah,
Maybe
okay. Sure.
maybe
Thanks.
just for me, maybe. Yeah.
No problems.
Yeah. Thank you.
Perfect. No problem. So we'll go a bit slow. So this is the key message. We get to the next slide now. So capital growth helps you get equity to be used as a deposit for the next purchase, and you don't need to rely on personal savings. So this is why while you're building your portfolio, you need capital growth. Because see, for any purchase, you, as you know, you would need a deposit as well as a borrowing capacity, right? So when you are needing a deposit, you have got two options. First, you save that money from your salaried income, PYG income, after tax. So after tax, you have got all the expenses, and then with your saving rate, you start accumulating your bank balance, and that becomes your deposit. That usually is the slowest way to come up with deposit because of all the expenses and the tax consequences. There is a lot better way to do it faster, and that is through the capital growth in the assets that you have bought in the past. So if you are buying a property which grows really significantly in value, you can take that equity out and use that as a deposit for your subsequent purchase. And this is actually a tax-free money, because equity is tax-free money. You don't pay any tax. So as soon as the value grows, as long as you have got the borrowing capacity, you can take that deposit out and use that, sorry, that equity out and use as a deposit. Make sense? Okay. And then cash flow basically helps you in two forms. So cash flow helps you making sure that holding the assets are not financially painful. So if you are getting a property with slightly higher cash flow, then these assets, you have got minimal to no expenses out of pocket while holding them. So they are not causing any financial strain onto you, and that for that reason, you can actually hold them long enough, right? And if you hold an asset long enough, you also have the ability to have capital growth potential, right? And I'll give you just a rough example, right? So say, for example, you see a property today where you have got such a strong conviction that this asset might make you $2 million in capital gains in next 10 years, right? You should have the ability to be able to hold it for next 10 years to be able to get that $2 million equity, right? So if the holding the asset is financially painful, then you may not be able to hold them for 10 years, which means that you will also be missing out on the capital growth. So cash flow is super crucial. So even we say, man, the sole objective of building a portfolio is capital growth. Yes, you are right. But if your cash flow is out of control, then you can't even hold that asset to get the capital gains. Are you guys following? Okay, perfect. So also good cash flow helps you expand your borrowing capacity as cash flow gets added to your income, household income to service the loan and permits you also to withdraw the equity made through the gains. So I think most of you would be aware, but just I'm reiterating for people who are not. So say for example, you have made good capital gains in your portfolio. If you don't have the borrowing capacity, you cannot even take the equity out. You have got the money sitting there, which you have moved, but if you don't have the borrowing capacity, the only option that you have got is sell the asset and take the money out, which is again not the best tax effective way because you have to be paying capital gains and then while selling the property, you have got purchase cost associated. Perfect. So let's get to the other slide, which is capital growth versus cash flow. Right, so we keep hearing that we have to make a decent compromise bit, like you have to make a balance between capital growth and cash flow, and I personally feel that is a complete myth. So it's not true. Capital growth basically, and you actually need both, as I said, right? Capital growth makes you wealthy, but cash flow helps you to sustain to the path to wealth. So for a portfolio, both are important, but that is a complete myth that you have to trade off between, like you can only get one of the two, right? You can actually have capital growth, very good capital growth assets with a very good cash flow, as long as you know which markets you are as long as you are looking at the demand and supply fundamentals and are mindful of the rental yields that region is offering you, right? So you didn't just need to be choosing the locations carefully. So I've always targeted it both for myself, and that was the reason why able to buy my property numbers 2 to property number 8, which was my investment property number 1 to property number 7, 7 properties in just 18 months. So I bought them from January 2021 to June 2022, and the sole reason was because these assets, like at $310,000 giving $380 in rental, 292 asset giving me $450 in rental. So these kind of assets always helped me in the borrowing capacity aspect because they were also good cash flow. So I was able to continue to borrow. And then there are lending strategies, which is probably a bit of out of scope from this. But again, just to give as much knowledge and value to this group, there are also lending strategies that you can consider. Speak to your expert mortgage broker. They can help you out. So you usually start with tier 1, tier 2 lenders and then go to non-banking lenders and then also use family trust structure to be able to borrow more. So there are ways how you can expand your borrowing capacity using the trust structures. Okay, so now our process. See, the insights that we shared earlier are just not ideas, right? They're part of the process that has already created success for many of our clients. Like we have got clients for whom I've got 10 plus clients for whom I bought 4 plus properties in the last 12 months, right? And for a client, I bought 4 properties in 9 months, and nine months after the last purchase, we have made nearly $694,000 in equity with these 4 purchases. Again, all the 4 purchases were focusing on capital growth and cash flow together. So that has been the key again. So what I'm preaching here as part of this webinar, it is the exact thing that we are using for our clients, and especially for people who are wanting to build portfolios and not making one-off purchases, right? So we are finding areas where the demand supply metrics are favorable and also are offering better rental yields. So it's this strategy that helps our client confidently build successful property portfolios, right? So I'll just share some of the recent client stories with just single purchase. So we have done multiple purchases for some of these clients, but I'll just be sharing a single example of a purchase so that you can have an idea on what a good cash flow and capital growth on a property may look like. Right, have a look at this property. We bought this property in a suburb called Bushland Beach in Townsville. This is 350 meters from the ocean. It is on a 662-meter land size. The time when we bought this property, it was an 18-month-old home. So we bought this property at $465,000. The land in the area at the time was being sold around $170,000 to $180,000. And the build with all the fixtures and fittings, because this property has got all the bells and whistles that you can think of. So this property, the cost of the building along with all the fixtures with that heavy solar and the internal upgrades, the cost to build itself would have touched around $500,000. So we have actually got this asset like below the build price. So essentially grabbing the land for free. So this is a standard 422 configuration, and the money invested by the client on this property was $82,000. So cash on cash return, if you look at his capital gains in 20 months, from 465, it has gone to 670 in terms of bank valuation. We have got second property for this client anyway, but yeah, this was his first purchase. So now the money invested was $82,000, and the cash on cash return on this 82,000 in 20 months is 250%. So capital growth at the purchase price in 20 months is around 44%. Current rental in this property at the time when we bought this, it was rented at 600 per week. Now the current rental is 650. And also there is another concept that if you're buying in a market where the rents are rising, but once you make the purchase, your debt levels and your purchase price is locked, right? So your rental yields keep improving. For someone buying today, their rental yields would be poor, but your rental yields keep improving. I've got properties in my portfolio where I bought them at 6-7%, and now holding them 2.5 years, they are crossing or touching nearly 10%. So if you hold the assets, the rental with the rising rentals, the yields for you especially keeps increasing. So the comparables at the time were around mid 500s. Like we really got a good deal because the couple built their dream home and they were separating. They were just in a rush of selling. So again, another tip for everyone is like once you are buying a property from either the agent or the seller directly, try to understand the vendor's motivation because not everyone is looking for the top price. If you can frame your offer which suits their needs best, you would be able to get good deals done. Okay. So
Can I ask a very quick question, Rohit, on that property?
Yep.
When did you bought that? Like which year was that?
See, it is 20 months ago from today. Like,
Today. Okay,
so
that's
I
fine.
am looking at 2023 second half
Okay,
sometime.
that's fine.
It would be July, August, September sometime. I don't remember exactly.
That's fine.
Yeah, it was
Thank
20
you.
months ago. So in the second half of 23. Yeah. Is that okay? Yeah, okay, perfect. That's what you wanted to know. Okay.
Yeah.
Yeah,
Thank you.
this is again another property bought around similar time frame. And when I say 22 months, so would I be in July then? So this was bought at $485,000. For this client, we have bought third property already. So this property was again a 422 configuration. This was around 2 years old home at the time. And the value again is sitting around 670. The money invested here is $84,000, and in 22 months, the cash on cash return is 220%. So capital growth on this property in 22 months is around 38%. Current rental is 600 per week, and the rental yield is 6.4. So at the time, it was 2 years old home. Now it is 4 years old home. The land size on this is 416. It comes with leftover builder warranty. Yeah. So, and the solar and every other fixtures. For this client, again, Deepak has already secured his second property. He's again in the process. So this client has again, his property was bought at 400. So this client has never ever bought his property. So again, just telling you without revealing too much information about the client. This client lives in Wentworthville, single earner, wife not working, 2 kids, and doesn't have very high salary. So he got this property, the first property ever in Australia, and we have probably, I don't know how many, maybe 30, 40, 50 clients by now, whom we have bought the first property ever in Australia. They are just doing going rent investing because they can't buy $1.5 million homes, and 500, 600 price points in units are not capital growth assets. So they don't prefer to buy that and continue to rent there. So this property was bought at 418,500, and so this was actually, see, I don't believe in numerology. So this was actually bought at $420,000, and then using building and pest, we reduced another $1,500 there. Money invested by and the client was $74,000. He had to get some money back from India to basically complete this transaction. So yeah, it was not as comfortable as we feel for some people. So, but then he ended up gaining an equity or cash on cash return of 280% in 21 months on this purchase, and the capital growth is nearly 50% in 21 months. Right. So, and then it's again a good luxury home, 11 years old home at the time when we bought it. And the current rental is around 590 per week, and the rental yield is around 7.3%, 455 square meter. So I'll just share our last example here, and because we have got probably hundreds of these examples, I can't share all here. You can go to on our website and find a few. So this property was bought at $430,000. The current value in 22 months is sitting at 620. 422 configuration, 525 land size. Money invested was $76,000, and cash on cash return is around 250% in 22 months. Capital growth 44%, and it was again 1.5 meters from the beach. Current rental is around 590 per week, and the rental yield is over 7%. Yeah. So many people today, like when you talk about property investing, you would see many people buy property and hope it works out. And the common strategy or the theme that we see, because we are probably in that fortunate position where we keep talking to a lot of investors who either use us or don't, but we get to know what their investing style is, right? So it is very comfortable for people to be buying things in their backyard, right? But the biggest problem with that strategy is that, as I've said earlier, it is all about market cycle timing, which I'll be covering in the upcoming slides. So if you keep investing in the areas that you are currently living in because of your personal reasons, you are living in there and you are comfortable buying in the area, then and whenever you are ready, that could possibly be the best time or could just be the worst time to invest there, right? Because based on market cycle timing, every market just goes through a very massive phase of growth for 2, 3, 4 years. And then for next 5, 7, 10, again, depending upon how big of a city we are talking about and which city, they just go very flat or stagnant or with very little growth, right? So if you are just investing in your backyard whenever you're ready, you just need to be lucky to be entering that market at the right market cycle timing, right? And many people exactly use that luck strategy as a strategy, right? So they basically invest and buy a property when they think they are financially ready in their backyard and they hope it works out. But most who, like when you see someone investing successfully and making recurring capital gains and with each of these purchases, they are not relying on luck. They're using a strategy to scale them to the levels that they want. They have to be mindful of their cash flows, and that is the way how you basically build your long-term wealth. Okay, so now I'm now touching upon a bit on the market cycle timing, right? Real capital growth always understand. So whenever we say that the capital growth is based on just the suburbs or the property, no, that's not true. The real capital gain, 70 to 80% of the heavy lifting is done by the region, right? And based on the market cycle timing, if the region has got the favorable market cycle timing, you would make a lot of capital growth. You can buy the dud asset in a market where the market cycle timing is favorable, and you'll make a lot more capital growth in comparison to buying the best asset in a market where the market cycle timing is not favorable, right? So real capital growth often depends on market cycle timing. So this applies not only to real estate, but also to stocks and crypto. So any asset class, like you can be buying the best stock, you can be buying the best crypto, but if the market cycle timing is not favorable, you won't have good chances of success. It's very similar to, right, someone who loves investing in stocks, right? Say for example, you love Apple as a stock. You just love Apple. So, and now you want to be, as soon as you got financial ready, you want to go and buy Apple without looking at the market cycle timing. And if you don't look at the market cycle timing and it is not favorable, even with the best asset that you like, and you won't be making money. You might lose money. And real estate is exactly like that. An Apple stock can be compared very closely to your backyard, right? Like wherever you are living, you are just because you are comfortable investing there has no correlation to its growth potential. And your proximity to the location again has got no correlation to the growth potential. So Australia as a whole has got 15,000 suburbs, and in next 10, 12 to 24 months, there are going to be markets which will be booming. So if you know a strategy or a trustable way on how you can actually find those markets, you will be making a lot of money with each purchases. See, you could buy the best asset, as I said, but if the timing is off, you'll struggle to make money with any asset. And that's why successful investors just don't pick good properties. They choose the right time in the right market cycle timing and the right suburbs and then the right asset. So it has to start with the region and then the suburb and then the pockets of the suburb and then the asset. Property always comes in the end. You don't just look at the cosmetics of the property and then decide to buy because it looks fancy to you, especially for successful property investing. Okay, just give me a second. Okay, So you have seen how people build sizable portfolio even with average incomes, right? What sets them apart isn't money, but the strategy behind each move. Without the right structure, your second and third property could actually limit your ability to grow again. So this is what I have touched upon briefly again. You need to be using real portfolio, or property is always a game of finance. So like if you are wanting to scale your portfolio, you need to be working with the right professionals and not just buyer's agents. I'm talking because I'm a buyer's agent. You need a mortgage broker, even a good mortgage broker, even before a buyer's agent, because they will be unblocking you uh, for your next purchase. So right, having a brief understanding of the right structure is very crucial for you. And I always keep saying to people, like when a mortgage broker says that you can't get a loan, it just means that he can't get you a loan. You need to find a new one. So always keep looking. You will always find ways. If you're persistent, you will find people who will be willing to help you out, and you would be able to expand beyond which you initially thought was possible. But with a smart framework, right, you can keep growing, as I said, like even as interest rate shifts and market evolve. So interest rate shifts, okay, so not giving you again just my personal example, not picking many of my clients here. So when I started building my portfolio, interest rate was all sitting at 2.5%. It helped me in my borrowing capacity. But when I got to my property number 8, and then when I met an accident and I left my job and got into my buyer's agency space, because this is what I loved doing at the time. And that time, the interest rates were at 6%. So my cost of the loans has increased drastically. But since I was always mindful of my cash flow from day one, it wasn't as painful of an impact. And when I started my business, I had to take 200K equity out from my portfolio to have my expenses for the next 1 year covered. And then that's how. So sometimes, like if you are wanting to get into any business, like you have to burn your boats and keep moving. Okay, so now what you can do, right? So these are some very basic steps for anyone who is wanting to start fresh. Again, some of us are very experienced. They may have already done this successfully. But the first thing is clarify your end goal. Always start with your end goal in mind. Decide what you are building towards. Either is it lifestyle, early retirement, passive income, generational wealth, or whatever that may look like. Because always start with a goal in mind, and then with that goal, formulate a strategy to reach that goal, and then start acquiring assets aligning to that strategy, so that each asset acquisition is taking you closer to your goal, right? So assess your current portfolio, right? Look at your current cash flow, your equity, your loan structures. Are they really helping you grow or holding you back? If they're holding you back, then you might have to again speak to your accountant, financial planners, and mortgage broker collectively and understand if there is a way for you to optimize that. Then identify the right next move. So don't just focus on the next property. Focus on how it fits into your long-term goal, right? A property might look very fancy. That might be the best property for your friend. But if your outcome that you're wanting to achieve or your strategy is different, that may not be your right fit, right? So always understand. So at the moment, like we are buying properties in 4 different markets. So if someone comes to us and asks, out of these 4 markets, which is the best one, right? So there is no one size fits all. For different clients, we have got different strategies, and for different strategies, we have to map that strategy to the location where it would work best. So different strategy might mean that we might be mapping them to different locations. And then building a scalable strategy, right? You need to be using data analytics. You need to understand the demand supply data metrics, and then you need to also have a little bit of understanding or work with someone who has got an understanding of structures, and then an expert plan who can help you allow get beyond a few initial properties. Okay, so now this is the opportunity for us to answer all the questions. So you guys can answer or ask any questions that you may have. So we'll first go through the questions that we have got in the chat. You can keep adding more questions onto the chat, and then also in the end we will open the floor for the people to just ask what they want. They can just unmute and get on the camera and ask me.
Right, there's few questions I can see.
We'll
One,
start off.
the start. We can start from the top from Hemant Deshmukh. He's asking about do you have to repay the amount taken against equity?
Okay, so repay as in like, are we talking the principal or the interest on that equity? So if it is the principal, definitely equity is nothing but a loan component. It has to be repaid back. Have you got the response? No, okay. Okay. So I'm just answering. So if it is we are referring to the principal amount, it has definitely to be paid back, but this is again a loan, right? So if you have put that on P&I, you just keep paying the principal and interest, or if it is interest only, you just keep paying the interest. But again, it has to be repaid because it is a loan,
Yeah.
essentially.
And the next one is what is the, I think that's more of like a situation-based question. What is the average cash flow percentage-wise on the portfolio of 1 million to not feel the pain?
Yeah, see, I think it's a bit situation, right? So, like it could be painful for me, but may not be painful for you, depending upon how much of a disposable income you have and what your long-term goals are. So it can vary quite a bit, right? So say, for example, someone making 250K as the example of the couple that we have chosen, like 10, 15 grand negative may not be too painful if their intention is to only buy a single asset. Or maybe 20 grand may not be too painful if they are just wanting to buy a single asset and hold the asset for 10 years. But if someone who is aspirational and want to buy 5 or 10 of those assets, even 5 grand might become painful, right? So it's very situational based on your goals as well as your disposable income. And hope that helps. Like I'm happy to answer any further question on this, like if I've not clarified enough.
Okay, one question directed at you, Rohit. What is your LVR on your portfolio of 10.7 mil? So they want you to spill the beans.
Okay, no problem. See, my portfolio on this is sitting around 60%. It would be plus minus 2% here and there. I need to do the exact calculations. But I think at the point, I have got around $4.5 million in equity, all built
Yeah.
around 5 years.
And there's one following question on the same one. Do you clear your principal or only focus on paying interest only and buy new investment properties?
Okay. So this is again very subjective. So usually, see the good strategy always like again, I'll get to the theory first and then to the practical aspects. So if you get to like based on theory for investment properties, it is always good to go interest only. And if you have got a principal place of residence, whatever principal you are saving here, you just pay your non-tax deductible debt on your principal place of residence. That is in theory, you should be doing that. Did I do that? No, for two reasons. First thing, when I started building my portfolio, I was not as educated as I am today. Second reason, I was also short of my borrowing capacity. If you are actually at the verge of exhausting your borrowing capacity, interest only loan squeezes your borrowing capacity. Again, speak to a broker. I won't be, I can just provide some basic learnings that I've developed during the course, but interest only loans usually decrease your borrowing capacity slightly. So if you're at the verge of exhausting, then you might have to go principal and interest to be able to retain your borrowing capacity. Because okay, just to provide a little bit more insights there, right? Because once how banks basically look at your serviceability, right? They look at your ability to repay the loan. So if you are taking a mortgage of 30 years on a principal and interest, they are splitting the repayments across 30 years. But if you take a interest only loan for 5 years, then the bank calculates the PNI on the remaining 25 period. And as a result, your installments for 25, which is a 5 year shorter period, becomes high, which results in slightly lower borrowing capacity. So yeah, if you have got $2 million capacity and you are buying 700,000 assets, you may not be too worried. But if I'm sitting at 650 in terms of the borrowing capacity and I'm just looking at 600, 650, 700 purchase price, then I might have to consider P&I option.
Okay, so next one is little bit broad, but let's talk about some use case about it. They're saying that you talk about the right time to invest. Is it a good time now? Do you
Always.
have an idea how it is looking for next few months? So it's a bit broad.
Yeah. See, I can still provide my 2 cents here. See, definitely a right time. It's always a right time. So, when we say right time, we are always referring to specific regions, specific market cycle timing. As I said earlier in the webinar, there are always regions which will be growing in next 12 to 24 months. You would never like even can look at CoreLogic's chart for the last 50 years. There are always markets which will keep rising. 2017 to 2019, when there was EPRA tightening on investment lending, and they had brought that responsible lending laws, every major market, including Brisbane, Melbourne, was actually correcting at the time. right? So Brisbane was actually low itself, but Sydney, Melbourne were correcting, and there were other major markets which are correcting. But Hobart, especially in Tasmania, Hobart, Launceston were actually growing very rapidly, right? So those markets have not grown for the last 12 years, and they were just going bonkers, regardless of what the APRA lending restrictions were, right? So every time, whenever you are ready, just start looking at the markets which will be giving you good yields. You also be looking at the past performance, because something which has gone 250, and now everyone is talking about Brisbane, right? But Brisbane, there are many suburbs who have gone 250 to 300% in the last 5 years, right? So if a market has grown this much, then the potential of it to be growing in the next 5, 7, 10 years is not as high. It might still grow slightly, but I don't expect them to be again doubling in next 5, 7 years. So always the right time, you need to be finding the right locations, because there are 15,000 suburbs, and all different regions with a collection of 200, 500 suburbs will be just working at a very different market cycle timing.
Okay, so next one is can you buy an investment property first and then buy primary place of resident property and will be able to claim stamp duty exemption? I think it's more directed towards the
I
accountant.
don't know.
I'm not sure, Rohit. Can
Yeah, see, I would refer you to, because stamp duty is again a state tax, so it might differ on different states. I've kept hearing from people that in one state this is a possibility, in other states it is not. So I won't be giving you the concrete answer on this. I recommend that speak to a conveyancer or solicitor specific to that state. These are policies which keep changing, and each state has got its own. So in some states you can't, in some states that I am aware of, but yeah, again, I've just heard from people, so you should not be trusting that too much. So speak to a solicitor. Sorry, I think the first question was around whether it is a right strategy to be buying principal investment property and then buy your principal place of residence. Is that correct?
That's correct. First investment and then owner occupied, and then we'll be able to claim stamp duty exemption. Question is more
Okay,
of a
so
like,
sorry,
yeah,
Deepak. So I'll just cover the previous one.
yeah,
So what I was covering was is like you can definitely buy your investment properties first and then go for your principal place of residence. Many people who go the rent vesting route think that they will be, after 2 or 3 purchases, they will be buying their principal place of residence. Financially, they are capable, but then once they taste the success in investment property, they just keep going. And then usually rent vesting is a concept where you continue to rent in the place where you want to live, which could be a lot expensive market. And in financial terms, like from capital growth perspective, then that may not be the best market, right? So then you continue to invest in the markets where it makes most financial sense. So you definitely can. It is actually very helpful for people who are struggling to secure their deposit, because the pace of their savings is very less slow in comparison to the way the market is moving in their target location, right? So what people do is, rather than missing out on the capital growth completely while they are saving, they basically park their money in the best moving markets, and if they continue to do that for a couple of assets, then they can make good capital growth. See, all of my $4.5 million equity, like I understand, probably 1 million would have been done by my PPOR, principal place of residence, but the remaining 3.5 million has been built by the investment properties, right? So if I were to do that through savings, I probably have to live my life even on a very high package 5 times, and still ATO would not permit me, right? On a higher tax brackets, you are just getting taxed at 45, 48%. So yeah, definitely doable. But yeah, and a lot of people do that.
yeah. Just next question is like more of like a statement, but I still read it out. Can you compare Australian property versus share investment globally? I understand it's a leverage in property, but issues like entry and exit cost in property, is it comparable? Also, for example, gold has beaten all asset classes as well this year. Your comment and response, particularly, it's a 6% return per year as per the core logic.
Yeah, see, 6% return is in the overall investment, right? And understand, leverage is a very powerful tool. So you need money to make money, but it doesn't need to be yours, right? So when you are using leverage, you are getting a 6% return on 100% of the money, where in your case, if you bought that investment property, you might have just paid 10 or 20%, right? So though 6% return looks low, but if 6% in, like, say for example, just for easy calculation, right? You've just invested 10% of the overall money in a real estate, and the 90% came from the lender. And if you get 6% capital growth in this whole asset, your money is going probably growing 60%, right? Because your cash on cash return would still be 60%. So I think like considering from the money perspective, real estate is still a good investment asset. And I feel much more safer because I have got a lot more control. I wouldn't say like in 100% cases you can control everything in real estate, but you have got a lot more control and data analytics that you can play around and do it safely, conservatively, and still has got very good potential for capital growth. But again, regarding stocks, I've never invested a penny in stocks, so I would not be able to provide. I'm probably the worst guy to give advice on stocks. So yeah.
Okay, next question. I think it's related to our face, Rohit. I think, and how does the process looks like for a client?
Yeah. See, usually we discuss the fee along with the value proposition. So what I feel always is, because at this stage, let's assume I'm for free, right? You still don't have confidence on my ability that you still don't know my process, right? You still don't know how do we work end to end. So I think the first relevant question to any buyer's agents, not just us, is like, how can you provide value? Can you just tell us a bit about your process? How do we work end to end? How do you find the locations? What all parameters do you look at? Like once you have narrowed down the region, what all data metrics do you look at while doing suburb selection? How do you do pre-market, off-market property search? What is your 4-step, 5-step due diligence process? And if you have got multiple negotiation steps, what those look like? And all other steps, so that you understand the complete value proposition of the service along with the cost. So I personally feel telling you the cost without telling you what you get in return may not give you good indication, right? So for fees and what do we offer? Okay, now since you have asked this question, so I'll tell you briefly how we work. So the first part is always a discovery call that we do. We'll give you the link in the end to book a discovery call for anyone who's interested. Discovery call is more for us to understand a bit about you and your requirements, and then I can confirm you whether we are the right fit. If we are the right fit, then we get to the strategy call where we cover the value proposition and the cost proposition. So yeah, we may not be the cheapest in the market, but we are certainly not the most expensive. Yeah.
Okay, the next question is that I'm not sure whether uh, it's related to the investment or for owner occupied. Says that as first home buyer with borrowing limit of $650,000, is it worth to go with buyer's agent?
Yeah, see, again, when you say 60 for 650, see, definitely we have got clients who have got those borrowing capacity. The first example, I think first or third, second example that I showed, that guy had borrowing capacity of 450, right? So if you know what to do, how to do, then you don't need a buyer's agent, right? I never used a buyer's agent for myself, right? The only thing that I say is like, if you don't know how to do it, then first learn it thoroughly and then do it. There is nothing in between. You don't want to try doing it because it is not like painting a wall. There is a huge money at stake. And I think with the real estate, the biggest problem is that whether you have done it correctly or not, you at least need a couple of years to realize that, right? So if you don't have the skills, you don't have the confidence, then just don't try it. But if you think you can learn about it, do it yourself, have got the time, have got the skills, have got the passion, man, you can do it by yourself. Then you don't need a buyer's agent. So if you're sure that you can do it yourself, go for it. I've done it myself. I've never used a buyer's agent, but I was just passionate a lot about learning how it is done. And I have made a lot of mistakes even after learning so much. And that is what we provide as a value. So my clients are starting from property number one very correctly, like and the learnings that I've developed by when getting to my eighth and ninth property. And again, it's a matter of repetition, right? Like even if a buyer's agent is not that smart, they are just doing a lot of repetition of the skill, and repetition is the mother of skill. So that's the reason why they get really good at what they do. But if you're
Oh,
confident doing yourself, you can.
okay, the last one I got over here for the first time buyer, is it better to go with rent vesting or primary house and then use the equity to build the investment portfolio?
See, again, no one size fits all. It is very personal. Going for an investment property is always an personal choice, right? I always keep saying this, like, if sorry, buying your principal place of residence. Buying your principal place of residence is an emotional purchase. It may not be the best financial decision, but not every cent from your pocket needs to make sense. It is very similar to buying a Ferrari, right? Is Ferrari buying the best financial decision? No, right? But you buy Ferrari for your own personal reasons, right? So PPOR could, like, for many people, they don't want to build portfolio. They want to buy a home where they live in and they call that their own home, right? So again, may not be the best financial decision, but not everything needs to make financial sense. So a very personal decision, like where you are more driven by emotions and your personal needs, and the other one, when you are going through the route of rent investing, it's more analytical and financial decision, where you are thinking, like, you are not so emotionally connected with your decisions. You are wanting to get the best bang for your buck. And then because if you go the rent vesting, then you are detaching you from the physical restrictions, right? If you are buying a principal place of residence, you are buying within 20, 30, 50 kilometers of where you are, where it could be the best time or the worst time to invest. But if you are going the route of rent vesting, you are freeing up yourself from that restriction, and then you can invest anywhere in Australia at whatever distance. And if you know how to tap into the best markets, you have got the maximum upside potential there. Hope that helps.
Okay, the next question I think Sohail has already answered. I'll just still read it out for you. Has government got any scheme for investor? Unfortunately, none.
Yeah. Government doesn't like people. Yeah. Government, yeah.
Okay, the second there's another question. Is there any certainty that property prices will increase, rental yields will remain stable, or market conditions will continue to be favorable?
Yeah.
After all, we are paying the BA fees. Yeah.
Yeah, even if you don't pay a BA fee or you pay a BA fee, there are no certainty. Even if you invest yourself, you invest, like, you have to go, like, see, if you're looking at data metrics, you have got more likelihood of doing it right than doing wrong. You look at the results of what people have achieved, but again, there are no guarantees in any investments, right? Like,
Yeah.
however you may feel, it's, yeah, no certainty. But I think if you start educating yourself, there are strategies that you can adopt, which increases your chances of success a lot more than the chances of failure.
Okay. The next one is buyer's agent fee tax deductible for investment property. I believe at the time of the selling, Rohit, is it correct? At
Yes,
this time.
see this. Okay, so I'll answer now since you have touched upon. I don't want to touch these doubts myself. So this is not, you really cannot claim that as a maintenance expense in the year when you purchase it. It gets added to your cost base. And consider that very similar to stamp duty, right? You can't claim stamp duty at the time or in the year that you bought it, but at the time of selling, that gets added to your cost base. So that reduces your taxable income. So yeah, it's not a money that goes down the drain, but yeah, it's not claimable in the same year that you are buying that property.
Okay. The next question. Thanks, Sohail. Thanks for messaging me. I missed this question. If someone has capacity and willingness to buy two properties worth of $500,000, what could be the possible state you may target and why? Considering he has two properties and both in Victoria, yield on investment of at 4.5%, and other one us is home.
Okay, so if I understood the question correctly, you already have got two properties, one
Yeah.
both in Victoria, one is principal place of residence where I don't care about the yield because
Mm,
you're living there, but the second property is again in Victoria with a lower yield. Now,
yes.
your question is that if you're wanting to buy two properties, 500,000 each,
Yeah.
which areas should you be targeting?
Yeah, spot on. Thanks
Okay.
for bringing it up, Deepak, and
Thanks.
thanks Rohit for spot on, like picking everything correctly in the first go.
Okay, no problems, no problems. So see, okay, now I'm trying to map that to the locations. See, honestly speaking, now being very, very transparent, we are not taking even signups for people, us, as for anyone who has got a budget of only 500 or 550. I've got repeat clients who are coming that they want two properties at around $900,000 combined, and I'm not taking their sign up. And the sole reason is I can buy property. Buying a property is not a problem. I can buy it like within a week, right? But we have got our brand to protect always, right? So in the markets, if I see that they don't have a good potential for growth, then I try to stay away from those markets. right? So for that reason, 500 purchase price, I think you've got a lot of, like, you can target so many markets in Queensland. You can, like, I keep getting those properties every second day, but I don't pitch that to any of the clients, even for the clients who are willing to sign up. The thing is, because I don't have high confidence in them to be a good asset for holding long term.
And the reason, Rohit, I mentioned for 500,000 was because I kind of got an idea because I've been researching in the market anyways. But I think the reason I pointed out in this question was because, you started your presentation with a price range of 400 to 500.
That is correct. Yeah.
That's kind of triggered me asking, oh, is there
Oh, yeah,
some...
yeah, yeah.
Yeah.
Okay, so I'll elaborate on that, right? So the time when we made those purchases, right? So understand the price points have really shifted quite a bit. So if you were talking to someone maybe in 2018, 2019, they might be showing similar presentations. I was not a buyer's agent at the time, but if I was, I might be giving you examples of 250, 300, right? So slowly and slowly, the way the demand and supply across Australia is panning out, these prices, like even at 600, 650 prices, I think within next year or two, you will start seeing them less and less. Like the prices again, Victoria could be an exception there, Melbourne especially, but in many markets you are seeing those prices, like, just we never thought the markets that we have invested in, we definitely had a very, very good understanding that these markets will be rising, but we never expected them to be rising 50, 70% in 2 years time, right? So the prices are just extinguishing for the right pockets. So my recommendation always is, like, Sohel, for you, my recommendation is, if you have got a budget of $1 million and you are just because you want to buy two assets and trying to fit that in, my recommendation is get one asset at a right price, get the right asset, because you don't want to be accumulating cheapies. We bought those 400K properties because those were best assets at the time, which we can buy for 400, right? So at the moment, if you can get some asset for 600, 650, and for the remaining 350, if that is not usable at the moment, you can either wait for some time because the interest rates are cutting, which might enhance your borrowing capacity again, or you can speak to a broker, your broker or some other smart broker, that if you can, they can tap you into another lender which can actually give you a better lending. Don't compromise your today's assets for tomorrow's asset. Like, you don't want to buy a worst asset today. And I've been educating this to my past client, and I'm not successful there. So I'm just not taking sign up. I'm telling him, man, because you want to buy two, you are just wanting to get cheapies without realizing what it might harm you in the next 2 years. So even get one, preserve that borrowing capacity, work with another lender if they can, or there are trust structures using which you can actually enhance your borrowing capacity and continue to speak to your broker.
Thank you.
He should be able to help you.
Okay.
But get a good asset.
Yeah. So next question I have, is it better to pay off the first property faster and then leverage that to buy more? Or is it better to hold cash towards the deposit of other property?
Sorry, is it better to pay off the first property faster first?
Faster and then leverage that to buy more? Or is it better to hold cash toward deposit of other property?
Okay, so see, it may not okay. Now to answer this question, see so I understood your question, but I'm trying to see if how can I explain it better to you. So if your situation is that you have got a principal place of residence and you have got some deposit, so I think your question is, should I pay my principal place of residence faster, and or should I use this as a deposit to buy the next one, right? So if you are using this savings as a deposit, there's a way where you can pay your principal place of residence and then take that equity out to make that equity component as where you can claim taxes against the interest on that in the next property that where you're using it as a deposit, right? Because if you use a savings as a deposit, there is no expense against the saving, right? But if you are using that from the equity, you can claim that in taxes. So it is just a better tax effective way. Speak to an accountant. I just tried giving you a little bit of summary there, but speak to your accountant and I think he can advise. But if your question is more regarding whether you should be paying your debt faster or you should be acquiring your properties faster, again, depends what your goals are. If you are in your acquisition phase, in acquisition, see, portfolio building is very much like bodybuilding, right? Once you get in bodybuilding, you get to the bulking phase. property portfolio is similar. You get into the acquisition phase where you want to acquire as many assets as fast as possible by timing the market correctly, and then give them enough time in the market for them to grow. So say, for example, for someone like Sohel, right? He has got objective of buying 10 properties in 10 years. Let's assume he don't want to be buying one property each year for 10 years and then get out of acquisition phase, because the asset acquisition towards the tail end of this period, he may not have given enough time for them to grow. So he might want to buy these 10 assets in the initial 2-3 years and then give them enough time, hold them long enough so that they can get in touch. Sorry, they have been given enough time to grow. And then at the end of the see, you get to the acquisition phase, and then similarly in bodybuilding, when you get to then leaning phase, here you get into a consolidation phase, right? When you have accumulated your assets and they have grown significantly in value, now you don't want to be acquiring more. Then you get into a mode where you want to reduce your debt, and then you basically pick your some of your assets, pay the other half, and then get into the retirement or a passive income mode. So yes, so if your intention is to expand, don't focus on paying off your debt. Use tax effectively, use that deposit tax effectively to scale your portfolio. Once you, and again, everything boils down to your goals. So always start with your goals and then start formulating a strategy.
Okay, just another question, Rohit. Haven't property prices increased across Australia since COVID? I think Victoria shows otherwise, I believe.
Yeah, so yeah, Victoria has grown like during the start of COVID, but not later. So what the question is? Sorry.
Haven't the property prices increased across Australia since COVID?
Yeah, they have, and I think I personally feel again, I could be wrong. Again, no certainty here, but I personally feel the next 2-3 years are going to be again a massive bull run for real estate if you are picking the right markets. The reason is we are in a perfect storm. Like if you start looking at the interest rates cut, the demand supply equations, and we are not able to build enough homes. The demand is always as high as always, and yeah, there are so many affordable pockets where there is a lot of pressure building up. So yeah, we
Okay.
might in 2028 we might again talk this think this as a COVID two phase.
Okay. Next question is that any properties that you could still, but within $300,000 mark
Yeah,
anywhere around Australia?
yeah, definitely. Yeah, you can buy. See, if the intention is to only buy within price points, you definitely can. Like
Yeah.
even under 200K, you can. So buying a property is not a problem. All you need to understand is you are buying a property for an objective. There is a why behind your purchase. Is it really helping you achieve your objective? If not, then you have to find a question. If the objective is just to buy a property, yeah, for sure, but may not be aligning to your goals that you're wanting to achieve from that purchase.
Yeah, makes sense. Okay, I think last one I have on the card is, can you recommend a good broker and accountant?
Yeah, definitely. See, reach out to me. In the end, we'll be sharing our emails. So reach out to me over email or phone call, and I can recommend you to. I work with multiple now, not just one. The reason is because I have seen a lot. See, everyone has got their expertise, like us as a buyer's agent, right? We don't buy apartments, we don't buy townhouses, we don't buy off-the-plan stuff. We only buy freestanding existing homes because that is where most money is made, right? So similarly, each accountant, each broker has got their own level of expertise. So I've worked with multiple. So as soon as someone comes in and tells me when this is what I'm briefly looking for, I can map that to the best person I think can work with them.
Okay, I think that's the last question I have, Rohit.
So I think we'll open the floor for another 5 minutes and then we'll
Yeah.
move on. So if anyone has got any questions, they want to just unmute themselves, come on camera, we can just have answer any more questions that people may have.
Rohit, hello.
Yeah, hi.
Yeah, I'm Nikhil here. I just have one
Hi.
question. Like, do you deal with commercial properties?
No, I don't.
Okay, just residential.
At the moment, yes. See, we might dive into commercial, but I personally feel that may not be the best time. See, usually when you're talking about the portfolio building, right? Usually, again, exceptions are there, but usually best capital growth assets are residential assets. So people start how they structure their portfolios. They initially acquire n number of residential assets so that they have got a lot of capital lot of equity built from these assets and then use that equity as a deposit to buy a commercial. Because commercial will help you in your borrowing capacity because of net yields, but with commercial, you need larger deposit. First thing. Second thing, during COVID, commercial has got, again, depending upon which kind of commercial you are tapping into, but for many commercials, including warehouses, there has been a lot of yield compression that has happened, which means the rent remained the same, but the prices where it was yielding 10% or 9%, it was very easy pre-COVID to get warehouses at 9, 10, 11%, right? All of them have squeezed to 6 and 7%, right? And the reason why they have squeezed is because the prices kept rising, the rents were stable, right? So the yield kept decreasing. This is yield compression, right? So in commercial, especially in warehouses, in multiple markets, you can see from the last 1 year, the yield decompression is happening. Means the yields are improving, and the only way for the yield to improve is because the prices are correcting. So I personally feel, again, in commercial, you need to get into the right assets. You just need to get into the right assets and do a thorough due diligence. And I personally feel getting a commercial with a net yield of 6.5% doesn't make too much sense for me, because an asset should be capable enough of paying a part of its principal. So I usually like to have 2.5 to 3% spread between your interest rate as well as the yield of your commercial property, because you don't want to be having the whole principal payment or principal repayment responsibility onto you. If your yield is 6%, your rental is 6%, then you are essentially leaving the whole debt onto you. And usually, again, if you're not being creative, commercial will be rising along with the CPI. The prices usually rise with the CPI, which is negligible. So
Thanks, Rohit. Yeah,
yeah.
that sounds good. Thank you.
Okay, the one question I got, Rohit, on the chat window, do you work exclusively with investment properties, or do you also assist client in finding a principal place of residence?
We have assisted quite, I think, a few clients here in Sydney, but for principal place of residence, we just do Sydney. And yeah, we don't advertise that, but anyone who comes as a referral from our past clients, then we are happy to help. But yeah, not doing that outside Sydney. Anyone?
Okay, we'll give another 2-3 minutes. If anyone has any question, feel free to unmute yourself. And there's one question over. What is your acquisition timeline of a right property from onboarding a client? Also, what is the percentage of off-market property versus on-market in today's market?
Okay, so I'll answer both these questions separately.
Yeah.
So first one, the acquisition time frame is usually 2 to 6 weeks for us, right? But I always tell people, like in some cases, we might get lucky, might get something in first week. Our objective is always to get the best asset for our client. We are not having ever any intention of closing a client soon. So we are not just doing a sprint here. Our objective is to get the best price possible. Even if it takes us a month longer, we would do that, because we know we have got vested interest in client success, right? Because if our client property grows, it becomes our marketing material on our socials. If our client property grows, they come for their repeat purchases. They will be referring their family and friends, right? So usually it's 2 to 6 weeks, but again, we are in no rush to find a property and close a client. Answering the percentage of off market versus on market, right? See, at the moment we are probably closer to 80% off market or pre market. We are probably doing 20% on market, but it's not because we don't want to do we don't distinguish between these properties, right? At any given point, we want to be buying the best asset for our client, however it is sourced. So sometimes people have a thinking that our buyer's agent only provides value in off market and pre market. However, that's not true. So even in on market properties, if I've got an established relationship with the agent, and if there are 20 offers on the table, I have, in so many cases, we have won those deals. So sometimes we have got such a strong relationship. I know if it is with a certain agent, regardless of how many offers come in, as long as the top offer is very close to our offer and is still reasonable and a fair price, then we will be grabbing it with a very high confidence, right? So even in on-market, we provide value. But yeah, I think nearly 80% of our properties are on market off market or pre-market. They are more pre-market than off market. Hope that helps.
Rohit, maybe just one last question.
Yeah, sure.
So even for investing, investment properties, so how are you going to help outside Sydney? So in case if we have to go to do inspection or so how are we going to get your advice on this is the best property and all that?
Mhm. Sorry, I didn't get your question. So are you asking that how you would be able to go outside and
No, as a buyer's agent.
uh,
So if I have some property somewhere outskirts of Melbourne and
yeah,
you're in Sydney,
yep.
and if you're actually recommending that particular property, that particular block
Mhm.
somewhere will be good one.
Yeah.
So as a buyer's agent, what service do you give in order to buy that property?
Yeah, sure. So see, if it is Melbourne, I've got a local buyer's agent in Melbourne. So they will be
Right.
doing that physical inspection anyway, right? But if, say, for example, we end up buying in a location where we don't have a a buyer's agent local presence there, then in that case, what we do is, see, for any new market that we are entering, there is a lot of pre-work that we do as a buyer's agent. One of the pre
Mm-hmm.
we have to be traveling to the region to make sure that whatever data says, it also aligns on the ground, right? So say, for example, I've recently made a trip to like not recent, it's been a year now. So in Rockhampton and Gladstone, the data looks very favorable. Many BAs are investing there based on data. But when I make sure that whenever I'm investing based on data, I'm traveling there and staying there for 5, 6 days, meeting not only the local real estate agents to establish relationships. That's one of the work that I do. The other work that I do is interview a lot of property management companies, find the best one based on their capacity, their processes, and then negotiate good rates with them for our clients, and then
Mm-hmm.
also then meet locals on the ground to understand. So for giving you an example of Gladstone, right? I went to Gladstone. So many people were still investing and are still investing. I never bought a property after traveling and spending $3,000 there for a week, right? I didn't invest because once you start going to the ground and start understanding local fundamentals, you have to be matched. You need to be comfortable with that, right?
Mm-hmm.
It's very, very crucial for you. And say, for example, like Gladstone, there would have been a market where I would have traveled and I felt very comfortable. Data is favorable. My local analysis says it's good. And if I am now looking at a property there, I will be sending my property manager and will be doing a thorough inspection. So they become our eyes and ears on the ground. And also understand, like not in real estate, for any successful outcome, you always leverage relationships. So like even if a buyer's agent is an expert into anything, they will can never be an expert if they are moving between locations. They really cannot be an expert in the certain pockets of each suburb. You always need to be leveraging on the expert who has been living in the ground for 15, 20 years and knows those pockets in and out. So we always try to leverage relationships of our property managers that we have developed relationships with, and they do the complete physical inspection for us. And this is again a multi-level inspection. There, while they are inspecting, we are on the video. We do the inspection once, then we get a video recording done, and then we take basically get them to fill our complete our inspection checklist.
Right. Okay.
What are recorded evidence of if at the time of settlement or after settlement, if something falls off, like if something is inconsistent, then we can always reach out to them and complain.
Cool. Thank you, Rohit.
Okay. Thanks, Anand. Thanks for asking. Last question, Rohit. Not the second last. Do you expect clients to be working with you exclusively?
100%. 100%. And the reason is because see, we are putting time, energy, efforts for clients. Like if the client is not committed, we can't be committed either. Very, very like as simple as that. So if somebody is, I always tell people, like if you are wanting to try yourself through someone else, do that. If you're able to do that, well and good. But if once you think you need help, then trust. See, you can't go to a doctor and then start advising them that I need this or this or this, right? Like if you are going to a professional, trust them. And if you don't have a trust on them, don't engage them. So the first thing for you to always understand is ask the right questions, do whatever due diligence you need to do, and then trust them before engaging them.
Okay. The last one I got. Do you recommend buying land if someone does not have much borrowing capacity after their first house?
I wouldn't. Honestly, without understanding too much about your personal details, actually, I wouldn't. My recommendation to you would be if you think, again, telling from my personal experience, if you think you don't have a borrowing capacity, You might be talking to a lender directly. You might be talking to a broker who just does basic PYG deals. Just explore multiple brokers. Explore multiple brokers. You would really be surprised what a broker can do for you. I have, in my personal portfolio building, I have nearly changed 6 brokers. I always love my broker until the point they stop helping me. And that is the time for you to move on. So my recommendation is don't buy land just for the sake of making a purchase, because you may not be making money. I see lot of people, many of my clients who have bought properties and they sell it at a loss because they bought off the plan and they just make losses. It's very easy to lose money by buying a land unless you are very clearly knowing like what you're doing. So speak to a broker, see if there are ways to expand your borrowing capacity. Yep.
Okay, I think that's the last one.
So anyone else before we head on to the next one? We'll just probably give a minute if anyone wants to ask anything. Otherwise, we'll just move on.
Yes, Rohit, I'm having
Yep.
one question.
Yep, sure.
So, like within the budget, what I asked before, also like 650K as I'm buying as a first home buyer, but I'm thinking for the rent first. So I'm looking at I'm exploring two type of the properties. One is the new property in the area of 290 or 300 with a 422, and another is with the established homes, the pretty old home with a larger area of 550.
Yep.
So I'm exploring both the places, and that old established properties are in the old suburbs, which are very already established suburbs, and the new are in the newly developed suburbs.
Yep.
So which one? Like I'm confused. Like, okay, which one should I go with? In terms of purely investment and the rental, because my thoughts are like, okay, I'm believing that okay, that old established areas and the suburbs, maybe in the future the supply will be less and the prices will be much more. The growth will be much more as compared to what I'm thinking.
Yep. Okay. I'll provide you my inputs there. So see, I'm again, without knowing too much about which locations, which suburbs you are comparing in which part of the country, but these suburbs, I'm assuming that the established suburb with a larger component could be closer to the city and in much established pockets than the other Greenland development or this newer pocket, right? So in terms of like 20 years down the track, all these pockets will be existing pockets, right? Something which is closer to the city, talking like again only in terms of main capital cities, will be always more desirable. And always understand when we are talking about houses, always apply basic principle. A house has got two components, basically the build and the land. Building depreciates and the land appreciates. Understand on an older home. See, our philosophy, I'll tell you about our philosophy and why we basically hate house and land packages. Our philosophy is that if we are buying something new, we want to be buying this property just by paying the cost of the build and or less and grabbing the land for free. You cannot do that strategy when you are buying a house and a land. Like I've given you an example of 465 purchase that I've done for a client, which was 18-month-old home. In the area, if anyone was replicating that home by buying a house and building, they would be looking at 680, 690 in terms of their purchase price. And I bought that at 465. So only in existing dwellings you can do that. And when we are buying properties which are 40, 50, 60-year old, I want to be grabbing the build for free and just paying for the land. So I am assuming when you are going to, let's assume that these two houses are similarly priced, the house with a bigger land component, your majority of the investment is going towards the land and very little to the build. So financially, it makes more sense because larger component of your investment is going to an appreciating asset, which is land, and smaller component is going to be a depreciating asset, which is build. As opposed to the other location where you are probably paying a larger portion of your investment into the build, which is again going to be older. You have got a mortgage of 30 years. In next 30 years, if you don't pay it fast enough, in 30 years, this is again going to be old. So your majority of the money, like let's assume in this newer home, you're buying for 600K, 300 is the build, 300 is the land, 300 will go to zero. Now this land needs to be appreciated a lot more for you to be making capital growth as opposed to the other area where you might be paying 500 for the land and 100 for the bill, or even higher for the land, right? So I personally am very fond of older properties in well-established pockets for exactly the same reason.
Right. Thank you. The same I'm thinking.
Yeah.
Only that what suggestion I got with discussion of one of the property agent is like he's saying that in that case, in the older established, you will be losing the your depreciation tax, which you are going to which you are going to get the benefit in the terms of the new property.
Yeah.
And another thing is like in new property you are having like 7 years of the construction warranty. So
Yeah.
these are the two elements which I will be losing.
So he's telling you exactly the right thing because they don't have anything else to sell this property. Understand? Okay, so now I'll tell you a little bit about I'm from the buying side. So if you talk about selling side, in selling side, usually an established property might be, if you're talking Victoria, agents might be given 2.5% at max for an established purchase. For a brand new purchase from the builder or house and land packages, the commissions are 8 to 10%.
Okay.
So that is the reason why people are always pushing newer builds. Government, why they are putting like their incentives on the newer builds, because they might be giving you home grant of 10-15K or first homeowner grant of 10-15K. It's not free money. It is essentially going from your pocket because they are wanting those stocks which have never been sold to get sold in the market, so that the taxes by the selling agent, taxes by the builder, taxes by the land subdivision guys who is the developer gets paid to the government. The government is making 100K once that property gets sold, right? And that is the 10K out of that, 15K out of that, they're returning it to you. So you are feeding for the immediate profit of the developer, the builder, the sales agent, where their commissions are high, and then your profit becomes a distant dream. So they do not have any other. Always understand, tax saving is not a wealth building strategy. So if they're selling an asset based on either their rental guarantees, they are selling their assets based on depreciation schedule, then it itself is a red flag because the asset itself doesn't have any other strong potential. Right. So my recommendation is, you just need to be smart there, understand where it makes much more logical sense for you to be parking your money.
Right. Thank you, Sarohit.
Hope that helps.
Yes. Thank you so much.
Thanks a lot. So I think I've got more questions. Okay, so I would like to, do you recommend buying land? Okay, thank you. I would like your perspective on the BRRRR, buy, repeat, rehab, refinance, repeat, real estate investment strategy, which emphasizes leveraging property value. Okay, so this is an active strategy. See, okay, so this is an active strategy, right? Like not everyone wants to do that. You can also make money by just buy and hold. But yeah, this strategy is good enough. Like you can always do that if you have got, first thing, that much of a time and interest in doing those recommendations. Okay. Yeah, Alok, yeah, this is a fair point. Please speak to a good tax agent who can confirm what happens to the depreciation benefits at the time. So he's perfectly right. So half of those benefits you have to pay back. So these could be temporary reliefs, but yeah, half of them gets paid back. So Sakshi, do you recommend your clients to invest in units? There is hefty amount of body corp and other maintenance, but rental yield could be yes. Again, rental yield doesn't make you wealth. Rental yield units I do not recommend. Not at all. They are the worst asset types for capital growth. Understand, when you are buying these properties, you are not buying them cash. You're taking mortgage. Your intention is to have capital growth. Capital growth is what makes you wealthy, if you remember previous slides. And cash flow makes you make sure that you can sustain to the path to wealth. So here there is no path to wealth, which is the sole objective, because you are not getting capital growth. So my recommendation is, don't buy anything just because you can buy it. Get financially ready and get the best asset, even if it means you are 2 years late in the journey. Because 5 years down the track, you would understand that not only the money, the biggest thing that you have lost is time. Again, just my personal recommendations.
Yeah, Rohit, Nikhil here again.
Yeah, hi Nikhil. Yep.
Yeah, this NDIS property, right? I mean, I heard a lot of NDIS kind of property.
Yeah.
Are they like? I mean, I'm not sure like how, because the advertisement looks really lucrative, but I don't know. I mean, the long term in terms of building a portfolio.
NDAs are very, very good assets, like very high cash flow assets. Again, they are cash flow assets. They are not capital growth assets, first thing. They are very specialized accommodations built. If you get the tenants, they can beat any investment type in terms of cash flow. They can be very good, but they are very high risk assets. Very high risk assets is because if you are buying an NDIS, see, you need to do a lot of your own due diligence when you are buying NDIS. Because in NDIS, you have got SDA.
Yeah, sorry to interrupt you. When you see the due diligence, do you help with, I mean, that aspect?
I don't. It's very tricky. And
Okay.
again,
Yeah.
there is a lot of uncertainty in that aspect. See, NDIS is only good as long as you get the occupants. And currently in NDIS, I think they have got 3 or 4 categories. Everyone is building towards the highest where they pay you the most money, which is, I think,
High mobility. High
high mobility,
mobility.
something like
Yeah,
that.
they got rollers and everything.
So they have got those channels on the roof.
Yeah.
So those everyone is building to their needs, and there are very less. So when you see NDIS properties, always look who is advertising. It's mostly the project builders it's either the project sales guy or project builders. Because if they are doing it, they are offloading their product and they are giving you numbers based on the occupancy. But it is in many cases you would see they are doing that in a greenfield area, which means in newer established pockets where finding an occupant becomes really a pain. So if you don't get an occupant, then these properties sometimes are not that appealing to even a normal investor. And you actually spend fair bit of extra money to get it to the compliant, right? So be very cautious. You need to understand clearly what the SDAs are. You need to do a lot of work around the service providers.
Yeah, thanks, Rohit. I attended similar like a seminar by Goro Property. He's based in Melbourne, so I mean, yeah,
Yeah.
he was
See,
specialized in this kind
ask
of
them
thing.
if they can get you the if they're selling property, then only selling property, then problem. See, I've not seen seminar, but if they are giving you any kind of assurance that will give to you the tenant, they have done their due diligence on your behalf, then yeah, I think it could be a good investment.
Yeah, thanks, Rohit. Yeah, thanks a lot. I appreciate that.
No problems. Anything else, guys? Or otherwise, we should be good to just move to the last part. And
Yeah.
yeah, perfect. So if there is nothing, so I'm assuming there is nothing. Yeah.
Yeah, all good.
Okay, perfect. So see, if you had a clear roadmap to build your real wealth in property in the next 10 to 15 years, would you still keep guessing with your next purchase, right? So my recommendation always is, as I've seen in some questions, just because you can make a purchase, just don't do it. Understand first your why, and does that purchase fits with your why? Does that purchase fits with your objective? If not, then don't do a purchase. Yep. If you need any help, yeah, we are always there to help. So final summary, right? Today you have seen what's possible, real people building multi-million-dollar property portfolio in just a few years. It's very much a possibility, but you need to get it right. They started small, but they had a plan and they had help. So if you're serious about building your own sustainable, sizable property portfolio, let's map out our next steps together. More than happy to help. Now is the time to act. Again, act yourself, or if you need help, we are always there. So we'll be dropping a link in the chat to book a discovery call. You can also find this on our website, which is www.investeraid.com.au, and also on our website you can find our link where you can send your queries regarding mortgage brokers, accountants that you may have.